Hello and welcome to this episode of InFocus. I'm Candis Fitch, Portfolio Manager at TriCert Investment Counsel, joined today by fellow Portfolio Manager Dave Gill. Nice to chat with you again, Dave.
Good morning, Candis.
So we're talking today about the industrial sector. As we come up to the year end here, what are you guys seeing in the industrial sector overall?
Yeah, great question, Candis. Basically, it's been a tumultuous year, to say the least, as you well know, as macro and tariff concerns have dominated news flow over the last 12 months. And unfortunately, it doesn't appear that there's any relief in sight. This was clearly on display when the market sold off recently after the Federal Reserve released their minutes from their October meeting. These minutes seem to suggest that a rate cut in December is anything but a layup. And because of this, it's likely that the market will continue to be hypersensitive to incoming data on inflation and employment, which are the key components of the Fed's dual mandate. Therefore, I'd expect the increased volatility that we've been seeing in the industrial sector and the broader market to continue into year end.
Gotcha. So you said the magic word there, tariffs. What's the latest on tariffs in the industrial sector?
Yeah, on the tariff front, at a very high level, it appears that the worst outcome has been avoided, although the situation remains fluid. From an industrial's perspective, the current tariff regime appears to be manageable through pricing actions and/or cost reductions. However, most companies are still grappling with mixed end markets due to the impact of all of this uncertainty on things like consumer spending and capital investment decisions.
Right. That sounds like a bit of a difficult backdrop for these companies. Does that change our view on industrials, or what really does that mean for our outlook here?
Yeah, as a reminder, industrials are one of the more economically sensitive sectors, so they tend to outperform on a relative basis early and mid-cycle when economic growth is rebounding or approaching its peak, and then tend to underperform when the economy is moderating or contracting. Of course, every cycle is different, and other factors like secular tailwinds can come into play, but that's a general rule of thumb. Now, while macro matters, our view on the industrial sector is predicated on its fundamentals. And as has been the case throughout the year, the sector is trading at a premium valuation right now, even though the blended revenue and earnings growth rates for 2025 and 2026 are below the market. Because of this, we've held a less favorable view on the sector, and for the most part, that's kind of played out as the industrial stocks have booked relatively muted performance overall. Now, to be clear, there have been some pockets of outperformance like aerospace and defense due to increased defense spending, and the electrical equipment and machinery subsectors that offer leverage to the AI infrastructure build-out.
Right. I know we chatted a bit about defense in our last podcast together, but any other particular subsectors we should highlight this time for our listeners?
Yeah, I guess you've got to take the bad with the good because, we talked about some of the secular tailwinds that are driving the defense sector. We talked about General Dynamics and CAE, I believe, last time. And I thought it was only fair if we started to talk about a sector that maybe is under siege a bit. So if you look at the macro and trade concerns that have dominated the headlines this year, the railroads, have seen a lot of action because they're basically caught in the middle of all of this. And maybe just I can start off with giving you a quick background on the rails. So they're basically the ultimate economic barometer. That's because they move a wide variety of freight across their networks, which connect production centers to international ports and major end markets. They're critical components of the supply chain and a key piece of economic infrastructure. Their freight includes things like coal, automobile and components, food and agricultural products, energy and chemical, machinery and equipment, metals and mining, forest products, and consumer goods. Over the last 40 to 50 years, call it, the rail industry has seen significant consolidation, culminating in the business combination between Canadian Pacific Railway and Kansas City Southern in 2023. This essentially left six major railroads in North America, which operate effective duopolies in their respective markets. So in the east, you've got CSX and Norfolk Southern. In the Midwest and West, you've got Burlington Northern Santa Fe and Union Pacific. And then in Canada, from coast to coast, down into the U.S. and into Mexico, you've got Canadian Pacific, Kansas City, and Canadian National Railway. This market structure provides high barriers to entry, scale advantages, greater network efficiencies, and service levels, and rational pricing power. Having said that, railroads operate in a very competitive environment, vying for business not only with each other, but with other modes of transport. And in the freight industry, the dominant mode is trucking. Now, rails tend to be more cost effective and fuel efficient than trucking and excel at moving freight over longer distances, while trucking has some advantages over shorter distances and with more time sensitive deliveries. Trucking also offers greater flexibility and generally wider reach. Over the last several decades, rails have lost market share to trucking, due in part to things like reliability and service level issues. Because of this, overall rail volumes have been in decline. Two other factors have added to the pressure. Firstly, historically important key industries like coal are facing secular headwinds because of things like energy transition. Secondly, there's an ongoing freight recession that started a few years ago after the pandemic caused a historic e-commerce boom and subsequent massive inventory restock, leading to an unprecedented freight volume pickup in prices and in rates. This attracted new entrants to the market, basically creating a massive oversupply of freight capacity when demand ultimately subsided. A key performance indicator for the rail group is something called the operating ratio, which is basically an efficiency measure. It takes operating expenses and divides it by total revenue, so lower is generally better. If you look back over the last couple of decades or so, the operating ratios used to run sort of in the 80 to 90% range. Today, they're in the 60% range. One of the main catalysts for the improvement was widespread adoption of precision scheduled railroading, basically pioneered by the industry legend, Hunter Harrison. It represents a new service model, which basically is designed to benefit railroad customers by providing consistent, reliable, and predictable service. And then for the railroads, they benefit by increasing network fluidity, asset utilization, leading to better financial performance. It's widely believed that the sustainable floor for operating ratios is likely like in this 55 to 60% range, which means that the margin opportunity for rails, like the margin expansion opportunity for rails, may be largely behind us. So to summarize quickly, I guess rails face continued macro and tariff headwinds. The industry is mature. It's very competitive. Volumes are in decline, and there's only incremental margin improvement opportunities ahead.
Right. That sounds like a lot of negative points here for the rails. So, given all of this, why did you want to highlight the rails specifically?
Well, sometimes that's where the value resides when there are industry challenges, and that's kind of what we're seeing right now. So railroad sentiment is subdued because of all of those aforementioned issues, which in our opinion is creating a very attractive valuation profile. Secondly, while the macro and tariff headwinds will likely persist in the short term, we believe that they will eventually subside. In the meantime, rails are focused on controlling the controllables, like better cost management, reducing CapEx or capital expenditure intensity, increasing network operating metrics, aggressively pursuing new business opportunities, and improving service levels, which may improve their value proposition versus the trucking sector. Thirdly, while volumes are being pressured, industry structure supports pricing power, and rails have demonstrated the ability to price ahead of rail cost inflation, which has allowed them to deliver a solid revenue and earnings growth despite the difficult operating environment. Fourthly, rails have strong balance sheets and generally generate significant amounts of cash flow, which they return to shareholders through dividends and buybacks. Just on that note, lately we've been seeing many railroads accelerate share repurchases as they cite what they view in their minds as attractive share prices at current levels. While we're admittedly in the later innings of the margin expansion story, we believe there's still room to run on the rails, which may deliver operating leverage if the macro inflects. And even if that takes longer than expected, cost and revenue synergies may be available to those companies involved in recent deal announcements in the space. Basically, we've seen 2 major deals in the last few years, one more recently. And because of those deals, again, there may be significant cost and revenue synergies available to the participants. And so for all of these reasons, we remain somewhat positive on the rail industry within industrials at this current time.
Perfect. Well, thanks, Dave, for sharing your insights today. It's always great to hear from those with their boots on the ground. Of course, if anybody has any questions about today's topics, you can reach out to your TriCert Investment Counsel portfolio manager or your financial advisor at your accounting firm. Take care.